Imagine waking up and finding out your national currency just dropped past like 160 to the US dollar. Um, Levels we haven't seen in decades.
Yeah, that is a massive shock.
Right. I mean, for everyday consumers, that's a full-blown crisis. But for massive global exporters, it's basically the most profitable accident of the decade. Welcome to your custom deep dive.
Today we're unpacking the dramatic plunge of the Japanese yen and mapping out those intense ripple effects.
Exactly. Think of this currency drop like a high-stakes seesaw. When a currency plunges this fast, one side crashes to the ground, but the other is just catapulted into the sky.
And the side skyrocketing right now is Japanese manufacturing. We tend to hear weak currency and assume, oh, universal disaster.
Right. Total panic.
Yeah, but a depreciation of this magnitude is highly asymmetrical. Like
Yep.
major auto and tech exporters are suddenly seeing these unprecedented profitability boosts.
Here's where it gets really interesting, though. So for these big tech and auto companies, a plunging currency actually acts like, I don't know, a massive global clearance sale that magically increases their profit margins.
Essentially, yes. I mean, it's not just that a rinker yen makes their products cheaper abroad, though, that obviously drives up demand. The real magic happens on the balance sheet through foreign exchange translation.
Right, like doing your corporate taxes and realizing the exchange rate just gave you a 20% revenue bump without selling a single extra car.
Exactly. These conglomerates are earning massive revenues in strong US dollars. When they convert those dollars back into yen, the sheer mathematical volume of that currency translation heavily outweighs the increased costs of their imported components. The math just works vastly in their favor.
Okay, but I need to push back on that just a bit. Like, what does this all mean for the average person whose grocery and energy bills are suddenly skyrocketing while, these corporations celebrate?
Well, if we connect this to the bigger picture, it's a double-edged sword. That is the side of the seesaw violently crashing down. Japan heavily relies on imported energy oil, natural gas.
Because they don't produce much domestically at all.
Right. So a yen at 160 to the dollar means they are basically importing global inflation straight into the domestic consumer basket. And it goes far beyond energy. Roughly 30% of the entire Japanese consumer basket is made of imported products.
Wait, 30%? Oh, wow, that's huge.
It is. And when you overlay this collapsing currency with rising global oil prices tied to geopolitical tensions in the Middle East, the compound effect is severe. You aren't just paying more to fuel your car, you're paying more to transport the food you buy, which was also imported at a premium.
So everyday consumers are the ones absorbing all the direct shockwaves of that global volatility.
Exactly.
Which brings us to the financial plumbing of all this. This tension between booming exporter profits and aggressive household inflation is rattling the foundation of Japan's financial markets, specifically long-term government bonds.
Yeah, we are seeing yields steadily rising, which honestly hasn't happened in a very long time. For decades, the defining characteristic of the Japanese economy has been structural deflation and incredibly low, even negative interest rates.
Right, it was just completely stagnant.
Totally stagnant. But these rising bond yields reflect a fundamental regime change. The market expects inflation and economic growth to persist. Like, Japan might finally be emerging from its multi-decade deflationary trap.
Let's break down the why there. Investors aren't just demanding higher yields randomly. When inflation takes root and eats away at the future value of money, investors require higher yields on long-term bonds to compensate for that expected loss of purchasing power, right?
Spot on. The financial plumbing is reacting to reality. This isn't just local news, it's a massive shift in a primary anchor of the global financial system.
Okay, which leaves you with this wild thought to ponder. For over 30 years, the Bank of Japan has tried every deliberate, highly engineered domestic policy imaginable to pull the country out of its long deflationary spiral.
Right, they've tried literally everything.
Everything. So is it possible that chaotic global volatility, Middle Eastern energy shocks, and an accidental currency plunge just did the job for them? I mean, sometimes the only way to get a stuck seesaw moving again is for something heavy to unexpectedly crash down on the other end.